Take a moment and think about this. Every month your salary comes in, and a good chunk of it has already been taken out before you even see it. Have you ever wondered where that money actually goes and whether you could get some of it back? Here's the truth. Yes, you can, and completely legally. Today I'm going to show you exactly how. Hey everyone, welcome back to Aussie Money Force. Today we're talking about tax, and I know the moment people hear that word, they tune out. But stay with me, because this might be the video that makes the biggest difference to your pocket all year. Just a quick note before we start. I'm not a financial advisor, and everything here is general information. For your specific situation, always talk to a registered tax agent. Now, let's get into it. First, let's clear up a confusion a lot of people have. Tax in Australia works on a progressive system, meaning as you climb the ladder, you pay a bit more tax, but only on the portion above each step, not on your entire income. For the 2025 to 26 year, here's how it breaks down. The first $18,200 is completely tax-free. From $18,201 to $45,000, you pay 16%. From $45,001 to $135,000, it's 30%. From $135,001 to $190,000, it's 37%. And anything above $190,000 is taxed at 45%. On top of that, there's a 2% Medicare levy that applies to almost everyone. Now here's the misconception I want to clear up. If you earn $80,000, people assume the whole amount gets taxed at 30%. That's simply not true. Only the portion above $45,000 is taxed at that rate. Everything below stays at the lower rates. So getting a pay rise never actually makes you worse off. Now let me show you a strategy that I think is seriously underrated. It's called salary sacrificing into super. Imagine a portion of your salary that would normally land in your bank account, get taxed at your regular rate, and then it goes straight into your super account instead, before any of that regular tax touches it. That's salary sacrifice. Here's where the magic happens. Money that would normally be taxed at 30% or 37% as regular income is only taxed at 15% once it goes into super. So if you put $10,000 into super this way, you could legally save anywhere from 15% to 22% of that amount in tax. For 2025 to 26, the cap for this kind of contribution is $30,000 a year. And yes, your employer's 12% super guarantee counts towards that limit too. One honest thing I need to mention though, this money gets locked away until retirement. So this strategy is best for money you don't need right now and are happy to set aside for your future self. Let's get practical for a moment. When you file your tax return, the deadline is October 31st, or a bit later if you're using a registered agent. There are a few things people forget to claim, again and again. First, working from home expenses. If you work from home, you can claim a fixed rate of 70 cents per hour, and you don't even need detailed receipts for it. Second, work-related expenses. Things like uniforms, tools, or courses directly tied to your current job. Third, car expenses. If you use your car for actual work travel, not just your regular commute, you can claim using the cents per kilometer method. And fourth, charitable donations. If you've donated to a registered charity, that's deductible too. Just make sure you keep the receipt. One golden rule here: only claim what you've genuinely spent, and make sure you can prove it. The ATO does check, so stay honest rather than chasing a short-term gain. Now, let's talk about something slightly different from deductions: offsets. A deduction reduces your taxable income, but an offset comes directly off your final tax bill. The most common one is LIDO, the low income tax offset. If your taxable income is under $37,500, you get an offset of up to $700. It gradually reduces as your income rises, phasing out completely at $66,667. And the best part, you don't need to apply for it at all. The ATO calculates it automatically and adjusts your bill when you lodge your return. Here's something most people don't connect: the link between private health insurance and tax. If you're single and earning more than $101,000, or a family earning more than $202,000, and you don't have private hospital cover, the government charges you an extra 1% to 1.5% through what's called the Medicare levy surcharge. So if you fall into that income bracket, taking out private health insurance isn't just a health decision. It can genuinely be a smart financial one too.
Let's talk about property now. If you own an investment property or you're thinking about getting one, you've probably heard the term negative gearing. Here's the simple version. When the rent you earn from a property is less than the expenses tied to it, things like loan interest, repairs, agent fees, and depreciation, that shortfall becomes a loss you can deduct from your total taxable income. So if your property runs at a $5,000 loss and you're in the 30% tax bracket, you'd save roughly $1,500 in tax. But here's something I genuinely want you to hear. Buying a loss-making property purely to save on tax is never a good idea. The property itself needs to be a solid investment, one that grows in value over time. The tax benefit should be a bonus, never the main reason. Now, two things that hardly anyone talks about, and honestly, I think they're some of the most underrated strategies out there. First, the spouse contribution offset. If your partner earns less, say under $40,000, and you contribute to their super account, you get an offset yourself up to $540 a year. Second, the government co-contribution. If you're a low to middle income earner, roughly under $60,400, and you put extra money into your super from your after-tax income, the government will match 50% of your contribution, up to $500 a year. That's genuinely free money, and you don't even need to apply. The ATO sorts it out automatically when you lodge your return. These might sound like small moves, but over the years, once they compound, they can make a real difference to your retirement. If you're running your own business or working as a sole trader, there's one more tool worth knowing: the instant asset write-off. This lets you deduct the full cost of business equipment, up to $20,000, in the very same financial year you bought it. Laptops, tools, machinery, whatever your business needs. No need to depreciate it slowly over several years. So if you bought $15,000 worth of equipment for your business, that entire amount comes straight off your taxable income for that year. And timing matters here too. If a purchase is already on your radar, buying it before the end of the financial year lets you claim it that same year, instead of it rolling over to the next one. Here's some good news to end on. From the 1st of July 2026, which means right now, a small tax cut has already kicked in. That 16% tax bracket has dropped to 15%. This benefits anyone earning more than $45,000, putting up to $268 extra back in your pocket every year. And from the 1st of July 2027, it drops even further, down to 14%. The best part is you don't need to do anything at all. Just keep an eye on your next payslip. You'll notice a little extra take-home pay, and that's simply the ATO's way of giving a little back. So here's the bottom line. There are plenty of legal ways to pay less tax. Salary sacrificing into super, claiming the right deductions, making the most of offsets, being smart about health insurance. These are all small decisions that add up to a big difference over time. But everyone's situation is different, so for anything complex, always talk to a registered tax agent. More often than not, the money you pay them, they end up saving you far more. If this video helped, hit like, subscribe to the channel, and let me know in the comments. Which of these strategies are you already using to save on your tax? See you in the next one. Take care.